Let's get some facts. 37% of you aren't subscribed to this channel. That's almost 4 out of 10 just freeloading the alpha. So come on, hit subscribe and I promise to keep leveling up the show with the best guests and the juiciest insight. Go on, do it now.
Welcome back to Real Vision. I'm Ash Bennington. Today, I'm joined by Mike Cagney, Executive Chairman at Figure. Mike, welcome back to Real Vision.
Thanks for having me back.
It's great to have you back on the show. I know you've had a conversation with Raul already, but let's start from the very beginning and talk about Figure, the genesis, what led you to it, and what problem you were trying to solve.
Sure. So, we started Figure in 2018 and really around the idea that we feel blockchain is this massive transformational force for capital markets and the way that capital markets work. And specifically the ability to displace trust with truth through native digital assets allows for things like bilateral transactions, asset-based lending, things that can disintermediate all of the rent-seeking intermediation that happens in financial services today. And so we saw this as an enormous opportunity, and not just around the disruption of existing markets. I mean, a lot of people talk about blockchain's application to things like interchange or to the stock market, but really to greenfield opportunities. What blockchain does is opens up the opportunity to create liquid marketplaces and liquid financing ecosystems for assets that have never had that. And that opportunity is multiples larger than the disruption of the existing things that are out there. And so that was one of the things that was really exciting to us to lean in and build the business out.
Mike, one of the things that's really interesting about you and your experience in this space is you've been doing this sort of bleeding edge finance technology stuff for a long time now, going back 10, 15 years. You're the co-founder and former CEO of SoFi, which is a name I think many people in our audience have heard of. Talk a little bit about that experience and how that led to where you are right now.
Sure. So to do that, I'll go back even a little bit further. So I started my career in the late 90s. I worked at Wells Fargo and I ran the proprietary trading and structured product development groups there. And, as such, I had a direct visibility into the capital markets, and I was trading a prop book in the Asian currency crisis in 97, Russia default in 98. And it gave me a particular perspective about allocation of capital in marketplaces. And notably, to me, the bank was generally a poor intermediary or a poor capital allocator, not Wells specifically, but more generally banking. And so that kind of stuck with me. And in early 2000, I did my first startup, which is on the wealth management technology side. We grew that. We ended up selling that to Broadridge. And then I went and started my hedge fund. And, in the hedge fund, obviously, very close to capital markets and trading through the financial crisis of 2008, 2009. A lot of perspective around the failings of the capital market system and where things could improve. And, coming out of that, I was spending a lot of time looking at what Chris Larsen was doing with Prosper. Prosper was one of the first peer-to-peer lending platforms. And I really liked this idea of connecting sources and uses of capital. And to me, there was a huge amount of value in doing that. And so, I ended up going down to Stanford to do a fellowship for a year. And when I was down there with a couple of my co-founders, came up with the idea of SoFi. And the original premise behind SoFi was exactly that. It was finding alumni from a school to invest in student loans from that school because of the common affinity aspect, but because of directly connecting those sources and uses where the alumni can get a better return than, say, a bank deposit, and the students can get a better rate than they might get from the government or from a competing bank. And we really became a victim of our own success in that business model. The lending product became so popular and grew so quickly. There was no way we'd raise alumni capital fast enough to meet that demand. And we had to go to the wholesale capital markets and, do the more traditional financing side for that business to allow that to grow. But that had always kind of stuck with me about that opportunity for sources and uses. And so when I left SoFi in late 17 and I started thinking about what I was going to start next, and thinking about Figure, I'd been spending time looking at how DeFi was starting to evolve within blockchain. So Aave was really starting to launch in 2018. MakerDAO had done some lending at late 17, but it was really the Aave platform starting in 18. And I love this idea of community financing, being able to put up your stablecoin and lend against crypto on a secured basis, and the efficiencies that came out of that. And I said, look, I think that this is extensible into broad financial services. And so that was really one of the key catalysts around Figure was we felt that we could build something that, really disintermediated a lot of that intermediation that existed in marketplaces. And the area that we wanted to start with was securitization. So, in 2018, blockchain had already had a lot of missteps. We were going through the ICO boom at that point. We hadn't had the FTX debacle yet, but it's an industry that, as I've said often, never loses an opportunity to shoot itself in the foot in terms of credibility. And we wanted something real and tangible to take into the financial system. And at SoFi, we were one of the largest programmatic asset-backed security issuers in the marketplace, meaning packaging up loans and selling them in security form, and understood all the inefficiencies that came from that. And so I had this thesis that we could use blockchain to originate, aggregate, and securitize loans and save 85 basis points of cost. And this is a business that runs at 600 basis point gross margin. So 85 bips, 0.85% is a huge number. And I went to a bunch of banks and I pitched this idea. And universally, every bank said, this is awesome. We love it. We'd like to be the 10th bank to do this. Tell us when the first 9 have gotten it done. And so it was clear that no one was going to be an early mover on this. And I said, all right, I wasn't necessarily looking to stand up another asset management or a asset lender platform, having just built a very large one at SoFi. But I knew we had to do it to effectively be first mover on blockchain. So we ended up standing up a lending platform, and we started doing consumer loans on chain in 2018. We were one of the first to do those. As I said, MakerDAO done some stuff in 17, but really, in scale, we were the first there. And then, we did the first securitization of those assets in 2020 and the first AAA rated transaction in 23. And by the way, we ended up saving a lot more than 85 basis points of cost because of blockchain and some of the value props on it. But that was really the starting point for us, and how it got us into the blockchain in a deep way, especially on the RWA real world asset side.
Well, let's dig into that. You mentioned 3 specific use cases there. I was wondering if you could unpack each one of those and give us some examples of the specific role that the decentralized digital assets play in that ecosystem.
Yeah, I think there are 3 value props, and the first is transactional efficiency, and so one of the examples of this that I like to use is since 2008, every securitization to get a AAA rating, the rating agencies require you to audit every loan, and it costs $500 a loan, and that's just how it's worked. And because of the immutable,
for people who aren't familiar with that securitization process, walk us through the way that this was done, that $500 price point and what that entailed.
Sure. So if I had a pool of mortgages, let's say I had 3,000 mortgages and I wanted to bundle them up and effectively issue bonds against those mortgages, against the cash flows. And I want at least the senior stack of those bonds, the top stack, to be AAA rated. And what that means is the rating agencies say, okay, we're going to take each of these loans, we're going to deliver them to a third-party review service such as Citus, and they're going to go through and look at all the documentation, make sure everything was signed correctly, make sure the underwriting processes were followed, make sure nobody modified any data, either intentionally or unintentionally, along the process of that asset. And that cost is $500 a loan. So, typical securitization for us, that runs about $1.5 million, right? If we're paying $500 a loan for each loan, and on a $250 million deal. And so with blockchain, the way that we ingest the data is directly. There is no one keying the data in. It comes directly from source into the blockchain. The blockchain itself is immutable, meaning that we can't go in and modify that data or alter it or what have you. And so the rating agencies said, look, we can cut the scope of this down to 20 to 30% of the loans, not 100%. And we can cut the cost down to $100 a loan, not $500, because there's a bunch of things we don't have to look at because of the way that you use blockchain. And that has created a massive tangible benefit. We've gone from $1.5 million of expenses to roughly $90,000 of expenses because of that reduction. And that's on the transactional efficiency side. That's sort of the first pillar.
And when you talk about the data coming in from the blockchain and is immutable, that's literally from the lender. So from the point of origination of the loan, this data has been passed through cleanly and is stored on a blockchain in an immutable ledger.
Yeah, so what we're doing is taking things like a credit report or title or income information through a bank statement, and we're ingesting it directly to the blockchain, right? It's not coming to us where we're interpreting it and passing numbers on and so forth. The raw data itself is going into the blockchain, and it's sitting there in an encrypted object store against that loan file. And if I were to trade that loan with you, you'd have access to that encrypted object store and you'd be able to see that information. And so, because of the immutability, I can't go in and modify an income statement, for example, or I can't modify a credit score. And or if I'm doing it, I'm creating a transaction history against it, where I can't do anything either, again, intentionally or unintentionally in terms of that. And so, it really gets to the crux of blockchain, which is displacing trust with truth. And what we're doing is we're using it as truth, and that's the key power of blockchain. And this is why, for blockchain to really be effective, you need native digital assets. You need things that live on the blockchain, that have always lived on the blockchain. I always give IBM crap for when they ran their commercials about using the blockchain to track your strawberries from Mexico. They're like, well, the blockchain doesn't have eyes, and it doesn't actually know whether the strawberries are in the same bucket or not, right? That's not a good use case of blockchain. Putting a Picasso on the blockchain and sharing fractionalized interest in it, how do I know the Picasso exists? How do I know it wasn't sold 20 times over, right? That's not a good use of blockchain, even though others, like to tout it. And this is why I don't get invited to RWA conferences, by the way, because I'm like, putting an office building in Topeka on blockchain stupid. And, everyone's like, you don't get it. I'm like, look, we've done over $16 billion of loan origination on blockchain. We've done over $50 billion of transactions on public chain. Like, we know what the value prop is, and it's around creating native digital assets on chain. And that first value prop is transactional efficiency.
So let's talk about that. When you talk about this is essentially straight through processing digitally, and that's what makes it different. Am I understanding that correctly? That's the difference between the strawberries on the blockchain, the idea that you're essentially originating these loans on chain so that data is stored in a secure object all the way through, straight through processing from the time of origination to the time of aggregation.
That's right. That's right. And the immutability of that data, right? And the decentralization of that data, right? That it's not only immutable, I don't control it. It's in a public chain. And that's key because, you can have an immutable database. Palantir has an immutable database, but it's their database. And so again, in the desire to displace trust with truth, where you look at that information and what you see is the truth, that requires decentralization and it requires direct ingestion with no intermediation. This goes into a hot button in the industry right now around oracles and trusted oracles, and people trying to bridge these non-blockchain assets and represent them on chain. The problem with that is that just moves the trust to the oracle, and that, I think, introduces issues. And there's some people that say no, oracles are okay. I'm more of a purist in that I think you really need native digital assets for blockchain to work. Blockchain is not easy technology. I've posted about this in social before. If you ask almost any engineer, they'd tell you they'd rather not work on it because of the immutability. It's unforgiving, right? And so there's much easier technology to build and much faster technology to build on, but it doesn't have that decentralization and immutability that's really the superpower of blockchain.
Let me ask you this question. When you talk about this idea of native digital assets, I think everybody remembers that scene from The Big Short with the Jenga pyramid being built up, the idea that the loans being put in there were not what they claimed to be. Talk a little bit about, and I'll ask this in a skeptical way, how do you know that these are truly native digital assets? How do you know that nothing has been altered, nothing has been changed, and that the data that's coming in is in fact reliable?
So first off, to level set, the data is as good as the data is, right? So if you get a bad FICO score from the credit bureau, you're going to put a bad FICO score into the blockchain. The key is we can't modify it to put in the wrong FICO score into the blockchain because that credit report's coming over digitally signed, ingested directly, and then sitting in the encrypted object store. And so without touching it along the way, you're getting data from source. That doesn't mean the data is accurate. The source can still be wrong, but you're reducing one set of hands that can potentially modify that data.
It's a very interesting point, an interesting explanation.
Well, it kind of ties into the second value prop, which is around liquidity. And, when we started Figure, we started as a direct-to-consumer originator. So we look like a fintech on the top with blockchain on the bottom, right? Blockchain capital market, but we were acquiring customers using our balance sheet to lend, normal fintech stuff. And very quickly we went to B2B to C, where, we now have over 170 third parties that use our technology to originate assets on chain, including 10 of the top 20 retail mortgage companies. But in the beginning, we were still intermediating. We were still sitting in between them and the capital market. We were aggregating all the assets on our balance sheet. We were taking the equity capital risk. But what we started doing last year is just opening up a marketplace directly. So our originators can go in and they can sell their loans directly to the capital markets. No intermediation from Figure. We just earn a take rate on that marketplace. And this is really the direction that we're trying to take the business in. And it ties into the second value prop of blockchain around liquidity. And, as I mentioned earlier, there's a lot of misperception around liquidity on blockchain. This idea that you can take an illiquid asset and put it on the blockchain and suddenly it becomes liquid. For liquidity, you need homogeneity, you need ubiquity, and you need certainty, truth. And what we've done is our asset origination process is purely digital. There's no human involved. So there's no human subjectivity. So it doesn't matter if it's a guaranteed rate loan or a cross-country mortgage loan or a Figure loan, every loan's done the same way. So we have homogeneity across all those assets. There's a lot of assets, right? So, in July, there were over $800 million of assets originated on the platform, all on public chain, right? Which, by the way, we are the largest RWA player in the blockchain space. I think most people know that. But there's a lot of those assets. And historically, those assets have not been liquid, right? They've traded in one-off bespoke loan pools where you go out and get a bid from Apollo or KKR or whomever, and then they'd spend 14 days doing diligence on the back end to settle the transaction. But in this situation, all the remittance, the principal and interest payments are all on chain as well. And so I can look at that pool of loans and I know for certain they are what's being represented to me. And I know for certain what the performance of that loan pool is. And that's provided a backdrop where people have begun to trade those assets digitally real time. And so we run what's called bid wanted in competition, which is just an auction process. We run at least one of those a week, but we also run straight up limit order books for these loans. And this is in part why we've originated 16 billion, but we've done over 50 billion of transactions, because we've been able to bring liquidity into this ecosystem in an asset class that's never had it. And that liquidity is the second of the three legs of blockchain, of the value proposition.
And so who are those customers who are bidding on those order books?
It's institutions, it's hedge funds, it's asset managers. But where I'm ultimately getting this to is I want to bring this broader to the DeFi ecosystem. And that really kind of ties into the third value prop, which is financing and DeFi. And, as I said earlier, one of the things that enamored me early on about blockchain was the work Aave was doing and directly connecting sources and uses of capital. And, I was looking at it recently, and you can go on Aave today and I can borrow against my Ethereum at roughly 6%. And if I went to the wholesale capital markets, if I went to Cantor Fitzgerald or Goldman, that would cost me 9.5%, 10% for that loan. And that's, well, why is it cheaper in DeFi? Well, it really comes down to this Pareto condition. So Pareto is an economics term where when two parties connect directly without intermediation, they can negotiate to deliver a better result for both sides. And, in this situation, by disintermediating the bank as a capital allocator, the lender's getting a better return than they were getting before, which was zero before. The borrower's getting a better rate than they were getting before because they're not incurring the overhead of the lender. And it's a more efficient ecosystem. And so from our perspective, this has massive extensibility on the financing side and directly connecting sources of uses of capital. And what we've been doing is using our loans in the DeFi ecosystem. So effectively bringing them over and applying them in DeFi construct, both in Figure markets, but also on other L1s like Solana and other networks, where we're demonstrating how RWA actually plays a critical role in the financing side of the ecosystem. It's been the missing piece. Most of blockchain lending has been crypto-based, and a lot of RWA has been misrepresented. People are like, oh, I have $10 billion of loans on the blockchain. Well, if you can't actually use it as collateral or trade them, it doesn't really matter that they're on the blockchain. And, with our stuff, you can trade and use it as collateral. And in fact, we're bringing it over into the ecosystem and doing that right now.
I should say, just a quick note, Figure Markets is a Real Vision sponsor, but this interview is not sponsored content. It's just a deep dive into the crypto ecosystem and to talk about these ideas a little bit more broadly. Talk a little bit about that, the ability to use these assets as collateral, how they get discounted, what the haircut process is like, and what use cases you see those unfolding in.
Yeah, look, I mean, one of the key things and the key benefits, again, of blockchain, of having a true native digital asset is, traditionally, if I'm going to lend against something, I'm going to underwrite it. I'm going to look at, its cash flows, or if it's a counterparty, I'm going to look at their balance sheet, their income statement, their EBITDA margin, all the normal stuff I do in an underwriting process. But when I have true digital perfection of the asset, so I know that the asset is there. It's not a token representation of something sitting somewhere else in a vault or what have you. And I have the liquidity of that asset. I can go and look in the marketplace and see how deep the market is and how well it trades. I have the volatility of that asset. And I know what the attach rate is, meaning I know what the over collateralization of the asset is when I borrow or when I lend against it. I can make a lending decision off of those variables, right? Without having to underwrite the borrower per se. And that basically democratizes the access to the lending ecosystem. It levels the playing field so that we can all go in and make an informed decision as to how much we would lend and at what rate. And this is incredibly powerful, and it's necessary. And the reason it's necessary, I've always felt that this was the natural evolution of capital markets. Like, we were always going to end up in this spot. But there's macro events that have happened recently that are actually acting as catalysts to push us there faster. And that's starting with the Genius Act. And with the Genius Act, we now have legalization of stablecoins. We're going to get a whole set of infrastructure around stablecoin payment and stablecoin activity. We, by the way, have our own stablecoin, but it's a yielding security version. So it's a little bit different. It doesn't live under the Genius Act. But the Treasury is talking about this, and they're saying, hey, trillions of dollars are going to flow into stablecoins. They did a study that said over the course of several years, 6.6 trillion will go into stablecoins.
It's a massive number. I mean, that's a significant fraction of GDP.
Well, not only that, there's only 6.5 trillion in Treasury bills. So there's not enough Treasury bills to buy to act as collateral to $6.6 trillion of flow. And the Treasury knows that too. It makes them a little bit giddy when they talk about it. But the problem is they don't talk about where it's coming from. And it's coming from bank deposits primarily. And the issue is, in late 22, when the Fed started to tighten, the banks began to lose deposits. So when the Fed eases, banks gain deposits. When they tighten, they lose deposits. And paradoxically, the deposits are called liabilities, but they're not technically a liability per se. But what we saw is bank. That's right. What we saw was bank liabilities go from 18.2 trillion to 17.2 trillion in 23. So we lost $1 trillion of deposits when the Fed began to tighten. That caused the capital markets to freeze up. It caused Silicon Valley Bank to fail. It caused First Republic to fail. It forced the FDIC and the Treasury to come in with extraordinary measures. The FDIC had to overextend FDIC insurance beyond what it was contractually committed to do to keep from even further deposit play contagion. Like, it was a disaster that they barely averted. That was $1 trillion leaving, right? So if the Treasury's right and $6 trillion leave, like, what stands in that place? And the reason this is important is bank deposits fund credit. And so a lot of the non-traded, homogenous credit is basically borne by bank balance sheets. And so if they start losing
private credit markets,
private credit, that's right. If the banks start losing that, like, Apollo isn't big enough to step in and use their funds in their balance sheet to take what's leaving the bank balance sheets. Like, there's nothing that can stand in the way of that today. I think DeFi can do that. And what we're trying to do is demonstrate with our loans how you can originate on DeFi, get transactional economics, how you can leverage liquidity on DeFi and get better liquidity in marketplaces than you did before. But most importantly, how you can finance on DeFi. And we're going to these banks, if I'm a regional or super regional bank right now, they don't realize it yet, but their business model is under immense pressure. They're going to lose these deposits. You're going to move into what the industry calls narrow banking, where you separate the deposit gathering and the lending aspect of the bank into two verticals. And they're going to have to access alternative forms of financing. And I think DeFi can step in and do that. And so, I'm very bullish and very optimistic around DeFi's role over the course of the next several years as this deposit flight begins to happen, because I think it's the only thing I've seen out there that has a viable opportunity to step in and basically fill that void.
If you've ever wished you could ask me a question, any question, 24/7, well, now you can. The RalPal bot is my AI assistant, trained on all of my insights, macro research, macro views, even wine and travel knowledge. The RAL bot is available for everybody who subscribes to either Connect, Alpha, or Pro. It can really change your life. You get me as your mentor 24/7. The link's in the description. I think you're going to love it.
Well, you've just heard a very big idea. This is nothing short of a wholesale reappraisal of the way that banking and asset management gets done in the United States. Mike, I know you're very bullish on this. Let me ask you this. What is it that keeps you up at night? Where do you see the risks being? Where are the minefields? What are some of the challenges that you worry about when you think about this shift?
Yeah, I mean, look, if you asked me that a year ago, it was pretty clear it was the regulatory environment. The regulatory environment for the last 4 years has been very, very challenging as a blockchain company. And I'm very proud of what our team's been able to build at Figure in the backdrop of that regulatory environment. But it was tough. I mean, in 23, I was working with a bunch of banks to build a tokenized deposit product that paid interest. That I felt was a much better solution than FedNow and RTP. And the FDIC and the OCC came in and said, you guys can't do this because public blockchain isn't consistent with safety and soundness. And, I wanted a yielding coin, so I went the securities route. And ironically, even though the SEC was not particularly blockchain friendly, was able to go effective with a public version of stablecoin that pays interest, and so it had some net benefits in terms of the process, but it was exemplary of how challenging the regulatory environment is. That environment's gotten better. The Genius Act is a great step forward. Not using enforcement as a policy tool through the SEC is a great step forward. But the Clarity Act is a really important one, and it's one that's being met with a lot more resistance in DC. And the Clarity Act is going to provide a lot of definition around what is and isn't a security, how to deal with the cross settlement of commodities and securities, how DeFi works, and how DeFi could or should be regulated or not regulated. And so I worry a lot about that direction. I worry a lot about the maturity of the industry, and does it get mature fast enough to coincide with this deposit flow, right? Because we don't want to be in a situation where DeFi is still 2 years away and the banks are starting to hemorrhage deposits, because that's a massive negative on the capital market and the broader market. And then, I worry a little bit about our industry in the sense that, as I mentioned earlier, it's never lost an opportunity to shoot itself in the foot. And, I don't want more stupid stuff to happen, because it takes the focus off of people who are doing real building and really, creating value. And it allows the naysayers to say, look, I told you it's all a scam, right? And it's not a scam. It's huge transformative technology. It's generational technology. I think it's going to move more public market cap than any technology has done before it, including Web 2.0, right? But we constantly provide fodder for the naysayers to point as to why this is actually a scam, and so as an industry we need to be smart about that.
It's really interesting. You're in this sort of unusual position where you have to build early in order to be competitive, in order to be an early mover in the space. But at the same time, you wind up in this very unusual position of being not having regulatory clarity around all of those things. How do you manage that when you're the CEO of a company?
Yeah, and what you're constantly worried about is you don't want to be MySpace, right? You want to be Facebook, and that dynamic of being first doesn't necessarily mean winning. Because we do believe, especially as it relates to RWAs, real world assets, it is a winner take most market. And so we are leaning and moving as aggressively and as quickly as we can. And, I've been fortunate that I've always had a good relationship with the regulators and knock on wood, have not gotten in trouble on that front. And a lot of it boils down to, we just take a philosophy that if we're in the gray, is what we're doing defensible in that it helps our customers. And we feel that if we can say with all honesty it's helping our customers, before any benefit to us, we're often willing to lean in and take the risk there. And so we've done that. And again, the regulatory environment now, last year a regulator would come to you and say, I don't want you to do this anymore. And you'd say, all right, I'll stop. Right. This year, it's a more constructive conversation. They come and say, this makes me nervous. And you say, all right, well, let's talk about why and how to mitigate that, as opposed to just the wholesale, I won't do it. And so, I think the work that Commissioner Peirce has done with the crypto task force, but broader across all the regulatory bodies, being more open to blockchain as a solution, is hugely beneficial to the space, and I think going to really be accretive to progress and improvement that benefits everybody.
Yeah. One thing that the beautiful California naturescape behind you reminds me of, I'm sitting here in New York City on the Upper East Side. Historically, this island has been the capital of banking and finance going back before the British were here. I'm kind of curious how you think about this as being what the view is from California, how you guys are thinking about really attempting to rebuild the entire financial system around these digital asset rails. How do you think about that? And what do you think people should know about that process?
Yeah, well, look, I think one of the keys is, you remember, I spent at least half my time in New York, so I'm not completely removed from the New York ecosystem. But I think blockchain is global, and it isn't specific to any geography. Its value proposition transcends geographies. DeFi in particular is fundamentally global. And I think, certain things like putting stock on chain increases accessibility and access to folks that, trying to get a U.S. brokerage account to trade U.S. equities as a non-U.S. citizen ranges from hard to impossible. And so our ability to start generating native assets on chain opens up that access and that flow of capital, and I think is massively accretive to the space and the industry. So I think one of the things that we'll do is reduce the dependence on any particular geography and really bring it to a more global basis.
Yeah. By the way, I don't want to sound like too much of a cheerleader here. It's very early. It remains to be seen how all of this shakes out. But I think there are people who are visionaries, who are looking to try and figure out what that looks like, what the next generation of finance potentially, not certain yet, along decentralized lines might look like.
Well, no, I mean, look, 6 months ago, when I talked to potential investors, all the bankers would say, "Don't say DeFi; it scares them." After the Circle IPO, they're like, make sure you work a lot of DeFi into every conversation you have. Obviously the market ebbs and flows with these things. And, I just try to stay consistent, irrespective of what's happening in the market, as to why this matters. And I think, those three value props we talked through, the transactional benefit, the liquidity benefit, and the financing benefit, those are very clear, salient reasons why this matters and why it has this transformational capability.
Yeah, talking of IPOs, I should say, you're coming up on an IPO here with Figure this month. I know that you're limited in the things that you can say about it, but it's something that people who are watching this show have probably heard of.
Yeah, I mean, we publicly said that we have filed an S1. The S1 is actually publicly available, and our intent is to go public. And we think it's a great opportunity to discuss, to provide a platform to discuss the narrative as to why blockchain matters. So we're excited about it.
Mike, one of the things we were talking about off camera was what may be happening in the equity space. Obviously, Robinhood and others have talked about tokenizing assets. This is something that there's a lot of conversation about. Talk a little bit about how you see that ecosystem more broadly.
Sure. I think it goes back to sort of the fundamentals of centralization versus decentralization. One of the things I always get frustrated about is the bulk of crypto is still trading on centralized exchanges. And, think about how paradoxical that is. The reason you have cryptocurrency is to ensure the decentralization of these networks, yet it's trading on these centralized exchanges. And, you lose a lot of the value prop of blockchain in that context. And so, to me, to do equities correctly, you'd want to create native public equity on blockchain, right? And what the industry is talking about is taking a security that's sitting over a DTCC and doing a token representation of that on blockchain. And that's really an IOU, right? And that means I have to trust the securities at DTCC. It means it could be double pledged. It could be, all these issues that the whole point of blockchain is to eliminate that need for trust. And I was talking to someone at DTCC, and they're like, well, look, we're DTCC.
By the way, for people who don't know, this Depository Trust Corporation, this is the intermediary that is involved in the trading of securities on the back end for broker dealers.
Thank you for doing that. Sometimes I get overzealous when I talk about this, especially with the acronyms. But when I was talking to somebody at DTCC, they're like, well, look, we're DTCC. Why wouldn't you trust us? It's like, well, because you shouldn't have to. You shouldn't need to. A lot of people could have said the same thing about FTX before they lost a lot of money there, right? Or Celsius or all these other situations. And so, to me, what you need to do is create a native digital asset on chain. Now, why does that matter to the existing ecosystem? Well, sure, that means you don't need Depository Trust Corporation as a custodian because it's on the blockchain. So that's a $2 billion a year business. They hold $50 billion of street capital on any given day. There's some value in disintermediating that, but that's not a game changer yet, right? You need an exchange, but rather than a centralized exchange like the NYSE or the NASDAQ or Coinbase or Robinhood would promote, you run a decentralized exchange, meaning that it's a bilateral DEX, decentralized exchange. The buyers and sellers connect directly. I encumber my bid, you encumber your offer, we atomically settle, boom, no post-trade close, no post-trade settlement. It's just real time, right? Anyone with a wallet can attach to the exchange. Well, okay, that means NASDAQ and NYSE's role is very different than what it's been historically. But that also means I don't need an introducing broker. I don't actually need Robinhood or Schwab or anybody else. I can self-custody my stock and I can attach to the exchange and I can trade. And a lot of people would say, well, what about financing? How do you do that? Well, that's DeFi, right? That allows me to borrow against my stock. That allows me to control my stock loan, where rather than my broker doing it and passing me on a return that I'm completely obfuscated in terms of what the actual economics are, I lend out. I decide what I want to earn on it. I decide when I want to pull the stock back. And that's where you start building real transformation, the ability to use that equity as collateral on a self-custody basis, the ability to control your borrow, the ability to borrow against it. And that's where I think ultimately the industry goes. And the challenge that we have with blockchain and with disruption is it is so disruptive. Normally what you get on innovation is you get the incumbent doing first order derivative changes. But the thing is there is no change for DTCC where it still exists in blockchain. There is no change for introducing brokers where they still exist in blockchain, right? If you do it the right way as a DEX. And so this is why it's so hard. You almost have to bring entirely new participants into the market to build this up from scratch because the existing ones can't afford the level of disintermediation, of cannibalization that would bring if the technology actually became prevalent.
Again, Mike, these are really big ideas. I know it's early. I know there's a lot of risk, but what a compelling and interesting conversation as we talk about this from the macro and micro perspective. Really appreciate you joining us here today. Let me ask you this. Final thoughts, key takeaways that you'd like to leave our listeners and our viewers with.
Yeah, I just think that the Genius Act really is the genie out of the bottle as it relates to narrow banking. And I think that is a really important thing to keep an eye on, because if there isn't a way to offset deposit flight out of the banks, that can create a serious economic headwind and a lot of challenges in the capital markets. But if there is a way to do it, I believe that's going to be DeFi. That creates a huge opportunity globally for people to participate in that financial ecosystem. And so, that's what I think people should be thinking about first and foremost. Stocks on chain are cool and everyone likes to talk about them, but the reality is, the NASDAQ works pretty well right now. And that's, not a critical problem we have to solve for. Whereas $2, $3, $4, $6 trillion of deposit flight out of the banking ecosystem is, potentially catastrophic or potentially game changing in terms of what that does for blockchain and the financial ecosystem. And that's something I think everyone should stay focused on.
Mike Cagney, fascinating conversation. Lots of big ideas. Thank you so much for joining us.
Great. Thanks for having me.
Thanks for watching. Thanks for listening. Have a great day, everybody.
So you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, Everything there to help you in your journey. Just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.